Hey traders, this is Blake Morrow with Trader Summit, and it is Friday. I have Jim Welsh with Macro Tides. He's here to break down the markets, and we're going to talk actually a lot of different subjects today. Jim, I'm so happy to have you here. So welcome.
Always good to be joining you, Blake, for two reasons. I like talking to you, and because we do it on Friday.
Yeah, Friday, we know the week is over and or just about over, and we have a lot to talk about. But from what I understand, you're going to be leaving us for a couple of weeks.
I'm going to be going to Montana with my wife, and we're going to be out a little bit in the boonies. And the net result is we won't be able to have these conversations, much to my chagrin, the next couple of Fridays, and we'll be back after that. So I've tried to look at some of the longer term type of information that I think is going to be appropriate for the next, not just a week or two, but over the next coming months.
All right. Well, that's we appreciate that. And we do appreciate you and do understand that you do have to take some holidays from time to time, as much as we wouldn't prefer that. So our normal listeners, if you're watching this, you understand that Jim's going to be out for the next couple of weeks, but he'll be back at the beginning of September, and we'll crack on from there. So let's talk about this week. Stocks have finally started to roll over a bit, and this dollar strength at the end of the week, it actually caught me off guard because it almost felt like, to me, look in retrospect, it was kind of leading this little pullback that we're seeing in risk, but the dollar really exploded higher. Like I said, much higher than I thought it was going to go the last couple of days. What are your thoughts on the dollar real quick, just off the top of your head?
Okay. Well, just from a chart standpoint, the dollar got above 107 yesterday, which to me was kind of an important level of resistance.
Yeah.
I think there's a number of things that are pushing the dollar higher. Part of it obviously is euro weakness. And I've got a chart that we'll look at in terms of looking at energy prices for Germany, but that extends to the whole EU area. They are going crazy. And I think what that means from an economic standpoint is I have no doubt that Europe is going to be in a recession, maybe before the end of this year, certainly next year. And I think all those things combined. And one last thing, the economic data in the last week or so, Blake, on the US has not been recessionary. Retail sales were stronger than expected. Industrial production, unemployment claims dropped. We saw the employment report a couple weeks ago. So to me, there was a lot of built up, the US is in a recession or certainly going to go to one, which weakened the dollar. So I think a lot of things have come together to push the dollar higher. And the chart pattern now looks like, okay, 109.29. I think it's going to a new high.
Wow. All right. Well, that's interesting to hear you say that. We have, a couple key events that are coming up. Next week, we're going to have, obviously, the Jackson Hole Symposium. I think the market's starting to wrap its head around the idea that the Fed might not be so dovish. They might actually stick to their guns here, maybe because they were caught wrong-footed with the inflation genie, and then was behind the curve. So it'll be interesting. But let's break down some of these charts that you brought to us, and let's start off with unemployment, the unemployment rate table that you have here. Let me go ahead and share that data that you brought. And can you explain to us what we're looking at here?
Yeah. First thing, that the Fed doesn't have a choice not to be dovish, okay, or to be dovish. They don't. And this is one of the main reasons. People are excited about commodities coming down. The CPI dropped a little bit, but wage inflation is a real key, because as wage growth goes up, it passes through the rest of the economy. So what this table shows is what was the low rate of the unemployment rate going back to 1953. So each business cycle going back to 1953, what was the low in the unemployment rate? And then what was the high after the Fed had tightened policy and slowed the economy, and in almost every instance, slowed it into a recession. And what we can see on average at the bottom there, the average increase was 3.6%. So let's dial this back a little bit and look a little bit deeper. If you look at the April 2000 to April 2002, the increase was 2.1%. So that is the smallest increase. And yet, if we look at inflation in 2000, it was around 3%. We're at 9%, triple that amount. And the unemployment rate is a little bit lower. So we've got inflation at a 40-year high, and the unemployment rate at a 50-year low. And this history to me, Blake, says the Fed is going to have to tighten rates or hold them at a high level for a very extended period of time to slow the economy enough to allow wage inflation to cool off. And I don't think the markets have comprehended the implication of this.
This is a really important chart, Jim. So if I'm going to ask you this, and I'm going to put you on the spot a little bit since you're going to be gone, and I feel like doing it. You know, what if you had to fill in the blanks here? What would you fill in the blanks to where you think we're going to go? Try that.
I think, you know, what this chart suggests, 4.5 to 5% unemployment rate. And again, I'm being kind of optimistic there. You know, from 3.5 to 4.5 is only a 1% increase. 5% would get you 1.5, which is lower than any time. So if one wants to be an eternal optimist here, Blake, and you say, okay, somehow this is going to be different. Even though we got inflation so high, we're going to be able to get away with a much more moderate increase in unemployment.
And our unemployment rate as of July, you know, is 3.5%. So I mean,
yes.
I mean, I know it's all a lagging indicator, but you know, that's what the Fed's looking at, right? I mean,
this is my point, is that labor market tightness, Powell has consistently talked about that. And the main reason is wage growth has continued to ramp higher and higher. I think in the ECI was up 5.6, 5.8%. That's the employment cost index, which combines both wages, salaries, as well as benefits. And there's a really high correlation between wage inflation and core service inflation. So here we're at a time where we're shifting away from goods buying to service buying. And, you know, again, for the Fed, they realize to bring inflation down, they need to, at some point in time, really bring the rate of increase in wage growth down, you know, significantly from where it is. And in order to do that, they're going to have to slow the economy either materially in the short run, which again, they're trying to avoid, or bring it down where the growth is more between 1% and 2% for maybe 2-3 years. So this, either way, I don't think this is priced into the equity market.
Yeah. And on the increase, where do you think we're going to, how much in rates are we going to go higher, do you think?
Well, again, the Fed is penciled in, you know, 3.4 by the end of this year, 3.8 sometime next year. The next chart, as a matter of fact, talk about a segue. You asked the perfect question. Actually, it's chart 3.
I did that on purpose.
3. It's the third chart. So you have to jump.
Okay,
here's what the Fed fund futures are pricing. They're looking for, you know, you can see there's a huge gap between what the Fed is penciled in on their projections and what the Fed fund futures. So the Fed funds futures, we're not going much higher. And then the Fed by next year is going to be cutting rates at least twice. So just remember,
you said penciled in, but if you looked at this 6 months ago, it looked a lot different, didn't it?
It did. And I referenced that we showed this a couple of weeks ago, December 9th. The Fed funds futures were looking for 0.75% increases for all of 2022. And that was after inflation hit a 39-year high. Powell in November had said, yep, it's not going to be transitory. It isn't transitory. It's going to last longer. And yet in the omniscientness of the Fed funds futures, they only saw 325 basis point hike. So again, this just underscores the idea that markets know something, I think, is a joke, but yet people put in a lot of emphasis on this. And what we just looked at in terms of the unemployment rate and what the Fed will need to do in order to get inflation down. If we go to the chart number 2, which shows the CPI, so here we can see the shaded areas, the vertical shaded areas are recessions. So what we can see is how the Fed tightened policy, unemployment rose rather significantly during each of those leading into and then during the recessionary periods. So if the Fed wants to get inflation down, you can see that over the last 60, 70 years, it's required them to push the economy into recession. I know that 1995, the Fed was able to raise rates without causing a recession, but what we're dealing with today, Blake, is way different than everything that was happening back in 1995. So again, what this implies to me is that the markets are wrong about how much the Fed is going to have to tighten. And, I think the Fed hopes that it can avoid a recession, but when I review all this, it's very difficult to see how the Fed is going to see inflation come down anywhere near their target without being tighter for longer at a minimum. So instead of rates going up and down like it did in the 70s, I think their game plan is to raise rates up to a restrictive level, wait a little bit, see how that plays out, then raise them up a little bit more and keep doing that until they really get confirmation that inflation isn't just dropping from 9 to 6 and whoopity doo-dah. No, that it's really on the trajectory that gets it back under 3%, closer to 2%. And that in order for that to happen, wage growth has to moderate significantly.
Okay.
So again, I just think the Fed, what they're trying to do relative to history, I get it. I just think it's going to be challenging. And as we'll discuss in the September macro tides, and we may have touched on this last week, in the 70s, we saw oil prices go from $3.73 to $39.79. And what that then resulted in was increase in drilling by 5-fold. So, energy prices contributed significantly to inflation in the 70s, but we had a market response. In 2010 to 2014, oil was up 110, 120. Well, fracking came into being and really, hit critical mass. The supply of oil went up significantly. Oil then dropped from 110, 120 down to $40 to $45. We're seeing an energy policy in this country and globally that is anti-fossil fuel development. So the two things that happened over the last 70 years to relieve inflation, at least energy inflation, we're going in the opposite direction. So what that also suggests to me, Blake, is that energy prices have the potential of hitting just a higher plateau than they would have had we unleashed drilling over the last 5 to 10 years, or even started it right now from a psychological standpoint.
Guy, got it. Now, and one thing I do have to point out regarding like energy prices, especially when you're dealing with crude oil or whatnot, is as the world goes away from fossil fuels, that doesn't mean that we're going to have a collapse in crude oil prices. Remember that, whether it's OPEC or whether it's the US or whether it's, even the UK, that they control their outputs.
Right.
And how much they are drilling and producing, they can control price more than that. A lot of people believe that,
right.
Traders, they're like, we're moving towards green energy, and there's just not going to be use for fossil fuel, so I got to just short crude oil. But that's not really a good argument when when we control productivity of that. So
right.
Yeah.
So
it just makes maybe the Middle East less wealthy.
They're going to act in their self-interest, and their self-interest will be at some point in time they're going to pump less oil, to sustain prices as best they can. If we get through a period of economic weakness that extends, and I think we're headed toward a secular bear market in the stock market, starting sometime in the next 2 to 3 years. We may have already started, but I think there's potential that it's going to hold off for a little bit. Hey, if we go through 15 years of really sub-economic growth, oil prices could be under pressure. You're right. OPEC will respond to that. But for me, just looking at history in terms of how energy contributed to inflation, and then how unleashing market forces and allowing companies to drill for more oil and gas brought energy prices down. We're doing the exact opposite in this cycle. And there's repercussions for that. Irrespective, this is not a commentary about, gee, we shouldn't do, reduce emissions or anything else. It's just acknowledging this is different this time than
true.
2010 and then obviously the 1970s.
All right. Well, let's talk about how you incorporate this into the equity market.
Okay.
So, S&P looks a little top heavy up here. It looks like we're pulling back a bit. So what do you make of all this price action?
Okay, last week when we talked, I thought we would see higher prices. The S&P did rally a bit more, got up to 43.25, tagged the 200-day average, interestingly. But in this last Monday's weekly technical review, I said, okay, here's three paths. And so from the low in June, and you can see on the chart, and we've talked about this the last 2-3 weeks, you can see a rally up to 39.40 something, pull back to 37.22, and then this push higher. It's either an ABC up, and we're going to get a decent sized pullback or a big pullback, or it's 1, 2, 3 of the next bull market, of wave 1 of the next bull market. But since wave 3 is ending, what follows is wave 4. And that implied a drop of 150 to 200 S&P points, and then another rally to new all-time highs. The other alternative is the second one, larger bear market rally, where this 3-wave rally is wave A of a much bigger bear market rally. We'd see a wave B pullback, which would be a down, up, down that would carry the S&P down towards anywhere from 3,900 to 4,050. And then another 700-point rally to a higher high than what we just saw this past week. And then a much bigger decline. And then the third option was, hey, we've topped, we had a bear market rally, it's over, and we're going to new lows. So from a trade standpoint, you didn't want to add any new exposure near 4,300. And as I said in Monday's letter, it's probably a good time to take some chips off the table. So to me, all three options suggested we're likely to see a pullback. It was just the magnitude of the pullback was in doubt. So
I'm going to make the assumption that next week probably has more to do with Jackson Hole and the rhetoric that surrounds it over the next few days. So Jim, I mean, it's first of all, thank you for mapping that out. But how do you feel about the bond market? You got bonds that are,
getting beat up.
They're breaking down today. I mean, this is, you can see where we're breaking lower today. Yields are screaming higher. How's that happen in a recession? I mean, what do you make of all this?
Well, as you know, I'm not in the recession camp. We've talked, I think a recession next year, probability is going up a lot because I think of what the Fed has to do. But as you know, in mid-June, I was bullish bonds, thought yields were going to come down, recommended TLT, and then was fortunate enough to say, okay, it's time to get out in early August. And we got out on the exact day of the high. My expectation here was, again, you had 3 waves up into that high. So it's either going to be wave A with an ABC pullback for a B before we run to 125, which is the first option there. The second one is, hey, you had an ABC up, that completed wave 4, and we're going to new lows on TLT, which means higher bond yields. In early August, there was no way to know which way this was going, all right? So to me, the idea of selling at the top of a 3-wave rally makes sense because it's either wave 3 or it's the end of an ABC. And that to me, just from a money management standpoint, makes sense to do that. So here we are, the 618 retracement, 112, I think 92. We've cut a little bit under that TLT. So from a trade standpoint, if you believe, to me, this is a place to take a small position with a stop at about 110.85. Just in case that this is completing an ABC down for a wave B, and then we're going to 125.
All right.
But I think, I just can't see how Powell is going to be as dovish as markets expect. And slowly but surely, I think people are going to wake up to the importance of the labor market, how tight it is, what that means for longer term inflation. So,
makes sense. All right. Well, speak a little to me about gold, because I've got the gold bulls are yammering in my ear right now, and they're a little worried that and I'll just point this out because it's not on your chart. From this high here to this low right here, that 1800 was that was a 618. I'm trying to 618. That's not very good. Anyway, that was a 618 retracement, and we really held it around 1800. So what do you make of current price? Where are we going? And don't tell me we're going to new lows. If we are, we're just going to keep moving along.
Well,
I'm just kidding. I'm joking.
No. But you point out the 618. You did that last week. I noted the trend line going back multi months, but it looked to me like you had 5 up, which was constructive after what I thought was a completion of a big ABC correction that started in August of 2020 when gold hit 2070. So I'm still positive, except, I try to be realistic here.
Of course.
And so to me, get much below, 1728, is like, okay, I'll give it about a 1% just because of volatility in terms of 1710. I think there's the potential that if gold holds here, again, the target was 1850. It rallied $124. So a pullback to 1720 to 30. And if it holds, then an equal rally of 124 or a bit much would get us up to that 1850 to 1870 target. So to me, gold at the 1720, 1730 level is make or break for the bullish case.
That makes sense. But let's talk about the last but not least. Let's talk about the euro. Euro's really been under pressure. The dollar's strengthened. I have to say, and I know we talked about this, Jim. I mean, there's been a lot thrown at the Eurozone. It's still above parity. And I sit here and scratch my head on the daily and say, how's it still above parity? But we are starting to show some signs of weakness, and that means the dollar is starting to firm up. What do you make of this? And, do we have lower lows to go?
I think so, because again, looking at the high from 2-3 months ago, you can see 1, 2, 3. The euro did an ABC up to that trend line, failed, and then I use that 5 and 13-day moving average as kind of a short-term pay attention to it in terms of trend. That crossed on Wednesday, August 17th. Yesterday took out support, just like as the dollar was getting above 107. The euro broke down its recent support. So to me, chart pattern wise implies new lows. At the same time, once that happens, I think the euro is set up for a really pretty good rally. So again, you have to take whatever the market is throwing at you at any given time. And so, a month or so ago, I thought, hey, buying when the euro was at 100 par or less made sense. I think now standing aside and waiting for this to play out. As I showed on the top part of that panel, is electricity prices up 1,100% since late 2020 in Germany. So what's happening to energy in Europe, it's crushing is what's happening. And I can't see Putin doing a 180 and all of a sudden opening up the natural gas spigots and everything. And one other thing, the release of the SPR, we were talking about oil earlier, ends at the end of October. So that's going to be a fair amount of supply that gets removed. Plus some of the sanctions, really more tough sanctions that the EU has imposed against Russia go into effect, I think, the first week of December. So to me, the chart pattern on oil was, hey, the mid 80s should provide important support. And I think there's a shot that oil will make a move above 100 and maybe make a move up toward 110 in the next few months. So, that obviously has implications for the idea of inflation and everything else.
Yeah, there's some German officials. I want to say it was either today or maybe even it was yesterday, talking about how dire the economic outlook is for Germany. And I feel for everybody in Europe and the winter they're going to be faced with. So maybe that's the catalyst that drives that euro one leg lower. Who knows? It's going to be really interesting to see how the euro plays out over the course of the next couple months, in my opinion. But Jim, I want to say, hey, have a great trip. We're really going to miss you the next couple of weeks. But
bad timing in terms of where the markets are, but hey, it is what it is.
It is. It's the end of the summer anyway. But over the next couple of weeks, how can somebody get their hands on this September macro tides, as you're probably going to be traveling?
You can obviously
and
subscribe at macrotides.com. That's a really good way of doing it. If you want, I'll be happy to send a recent Macro Tides weekly technical review that covered a lot of the stuff that we just discussed. Send me an email, jimwelshmacro@gmail.com, and I'll be happy to do that. But the main thing is I think I'd like to believe, Blake, our conversations are helping people understand how to put fundamental analysis together, understanding monetary policy better from the Fed's point of view, and then the technical implications for financial markets. So I'm really happy that we get to do this every Friday.
Yeah, me too, Jim. And if you guys are happy, and you guys and gals, make sure you give Jim a thumbs up. Comment down below if you got any comments about what Jim's talked about, or maybe you have some input that you want to put in. I know Jim's perusing those comments, trying to jump in there and interact with you guys. So guys and gals, so make sure you do that. And if you see us on social media, subscribe to the channel, share this video. I know Jim would appreciate it. We'd appreciate it at Trader Summit. Jim, have a safe and wonderful trip, and we'll catch you at the beginning of September.
You got it. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.